Hi, everyone. Welcome to the Travillian Next podcast. I'm your host today, Michael Perito, head of bank strategy here at Travillian. I'm excited to have Isaac Wheeler from Derivative Path join us. Isaac recently was at our conference earlier this year in September, and with the forward curve being where it is and everything going on, we're lucky to have him. So, Isaac, thank you for joining us.
Yeah, thanks, Mike. Happy to be here.
I'd love to just give you a chance just to level set our conversation here. Tell us a little bit about Derivative Path and what you do there, and then we definitely have some questions and topics we want your opinion on after that.
Yeah, great. So Derivative Path is a financial technology and advisory company. We specialize in helping companies manage financial risk of all kinds, but my specific focus is helping depositories manage interest rate risk from kind of a top-down balance sheet world.
So we've had a little time now to digest the first 50 basis point cut. And I guess just the first question I wanted to ask you is, have you seen any shifts in strategy or in your conversations with depositories around hedging and rates since this 50 basis point cut?
Yeah, good question. So I would say that, I wish we lived in a world where everybody hedged before they have to. But the reality is that people will always be a little bit reactive. So, the Fed has finally delivered on its first rate cut. The market was, ascribing a very high chance on it happening. But I think that the fact that the Fed has finally delivered on one has definitely kicked up a little bit more interest in strategies that hedge against lower rates. The challenge is that now that the Fed is finally embarking on this rate cutting cycle, it's a lot more expensive to hedge that direction. So we're having conversations. I think some of the larger institutions out there are starting to hedge that direction. But broadly speaking, most of our clients would still say that it looks expensive to hedge against lower rates because of the shape of the curve.
Do you think there's a little bit of an issue here, though, that and I think this actually is multi-layered. I think as an industry, whether you're talking about executives, investors, bankers, you name it, we're just still not used to operating off of zero rates, right? I mean, so like when you say it's too expensive, how expensive really is it in your opinion? Is this like a case where people are like 5% mortgages aren't expensive, but it used to be 15? It's just like, do you think it's more of like a lens issue, or do you think it is actually right now like pretty expensive for some of these banks to hedge themselves?
Yeah, good question. I think it's even, to add another layer to it, I think it's less about the rate. So today you can convert, floating rate assets that are pegged to SOFR, to 5 years. You kind of extend out a little bit on the curve and create a 5-year fixed rate asset around 360. I don't know that our clients are necessarily saying that 360 is expensive. It's that 360 is expensive in a world where SOFR is still in the high fours. So it's more about the spread between short-term rates and their current deposit costs and that rate than it is about the rate itself optically. For better or for worse, I actually think that I probably had 0 conversations this year with clients where they've looked at the actual rate itself and said, that's expensive or that's cheap. Banks still really think about these decisions, and hedging decisions specifically, as it relates to the shape of the curve. So it's the inversion in the curve that makes things expensive, not the rate itself. And that's the real peril, is that we sit here with an inverted curve, and today, sure, 360 looks expensive because I have to give up 150 basis points of yield relative to where those assets are floating today. But the risk is that we just kind of don't hedge. And by the time short-term rates have dropped below 350, we'll be wishing that we had locked in these rates, right? So I think there's this carry bias that has always existed in the hedging world, and that's what people say when they mean expensive.
Yeah, I might circle back to that, but you mentioned the forward curve, and I think one thing that, like from a simplistic high-level point of view, right? You go back before the last meeting, everyone pretty much knew rates were going down. It's just, was it 25 or was it 50? Fast forward to today, I don't think anybody knows, right? Is it flat? Is it down? The election is basically right before the next meeting. I mean, the amount of uncertainty is very high. I guess first part of this question is just from your perspective. Obviously it's probably like a probability model. Nobody knows. But what are you telling clients that are some of the most likely outcomes based on what you're seeing and your kind of historical analysis of the curve?
Yeah, I would say it's self-serving argument, but from me and my standpoint, I think the only thing that's certain is more uncertainty, right? So we look back over the last 2 decades, a lot of the biggest moves in the 10-year have happened in the fourth quarter during an election year. So do we ultimately know how the market's going to react to either a Harris or Trump victory? Not necessarily, but I think we can be pretty confident that we're going to have a lot more volatility in the market when the winner is ultimately decided. So, I think that, and we were talking about this a little bit before, but I can make a very good case, I think, for dramatically lower rates or dramatically higher rates. And that's unnerving, I think. I don't think that it's easy to look at the forward curve today and say that it's clearly cheap or it's clearly expensive, one direction or the other. If anything, I think that the range of outcomes still seems really, really wide. And personally, if I was a financial institution that had a lot of rate risk, I'd be looking to mitigate that in some way.
It's interesting. Kind of a parallel to this conversation is one I have a lot with bank executives around like ROI on tech investments, right, and things of that nature. And I think sometimes it's hard to have these conversations unless you're really starting at the right endpoint and then moving backwards. And one thing you just said that resonates with me is like uncertainty is kind of the whole purpose of hedging, right? I mean, we don't know where we're going. That's why you hedge. And I think part of the problem is as an industry, we still talk way too much about asset and liability sensitive balance sheets. I think we probably need to move a little bit more to kind of holding NIM more stable and being able to make decisions based on your predictions around NIM being more stable, right? It's kind of like a different setup. With rates being zero for so long, I think everyone was trying to be asset sensitive. Everyone thought they were really asset sensitive, which obviously didn't always prove out to be true. But it's a difficult time. But on that point, I thought what would be interesting is if you could just walk us through kind of a simple hedging solution that you see, let's say at a bank, 20 billion and under in assets. That can make a big difference, because I think one thing that happens sometimes is banks, particularly on the smaller side of the asset spectrum, will think being hedged is maybe a capability that they don't have the luxury of affording. But I don't know that that's true, especially now I think with a lot of service providers like yourself. So if you're willing, I'd love to walk through a simple exercise, and I might have a couple follow-ups after, but I'll hand it over to you.
Yeah, sure thing. So I think that let's start with an example where an institution has a lot of confidence in what their profile is. Like that's, I think, a necessary ingredient in order to be able to hedge. If you don't know how you're exposed, we can't fundamentally build a hedging strategy for you. Let's take kind of your classic liability-sensitive community bank that funds themselves perhaps predominantly in the wholesale market, or at least the margin in the wholesale market, and the overall tilt of their balance sheet exposes them to rising rates. Today an institution like that might be saying, hey, look, we're set up pretty well. We see that rate cuts are going to happen. We're going to benefit from this. We're positioned well as a liability-sensitive institution to expand our margin as the Fed continues to cut rates. The first thing we would say as a hedging advisor is, well, the forward curve is giving you a little bit of a gift. There's a lot of accommodation already priced in. Let's not wait to see if the Fed actually delivers on these cuts. Let's lock it in today with some sort of hedging strategy. So specifically the form that would likely take is we would look at a collection of floating rate borrowings that the bank has that are tied to market indices, and we would term them out by paying fixed on a swap and converting that floating rate liability to fixed, or that series of floating rate liabilities to fixed. So we're doing that synthetically with an interest rate swap, but it's in effect as if the bank had borrowed with a term fixed rate in the market instead of maybe a series of rolling advances or CDs, which they have on the balance sheet today. The other way we could also do it is to swap some fixed rate assets back to floating. So we could take a pool of mortgages, we could take a pool of bonds, and convert those to floating as well with the exact same hedge instrument. And I guess where I'm going with this is that it doesn't really matter what we swap, whether it's a liability or an asset. Fundamentally how we get there in terms of specific assets and liabilities doesn't matter that much. But the basic instrument that we would be using in that example is that of just a very vanilla pay fixed interest rate swap.
That's interesting, and actually it kind of brings up something I wanted to double down on anyway, which was, I don't know if it's just me, but sometimes by default I feel like when you're talking about hedging, just because of the majority of the hedging world, forget about depositories for a second, it's a lot of securities focused hedging, right? Or people will hedge against bonds, but obviously for banks and depositories, their biggest asset is their loans. And when you're talking about banks, particularly sub 100 billion, a lot of those loans tend to be 5+ year fixed rate terms, right? I mean, that's where a lot of the CRE lending happens in the United States. There's still a lot of mortgages written by those banks, and they'll tend to be jumbos too, which a lot of times banks will hold. So like even if it's a 10-1 arm, that's still 10, right? I mean, it's still a pretty long-term asset. So, what can banks do, or what do you see your clients doing to minimize asset duration and the impact it has on their outlook at this point?
Yeah, good question. So it would often involve the same product I was describing earlier, so just a vanilla pay fixed interest rate swap. But more important than the specific derivative that a bank would use to hedge, in my mind, is the timing. So today when we talk to institutions that have these, they're not necessarily underwater because we're not marking them, but if we have these pools of low coupon mortgages or these low rate commercial loans that the bank has already originated, there's a lot of brain damage that happens when we talk about swapping assets that are already underwater to floating. There's a lot of questions about, well, is this the right time? Well, the Fed's going to cut rates. There's a lot of internal debate. In my mind, the first step that institutions need to follow if they're exposed to higher rates generally is just you need to begin to swap that origination as it's happening. Ultimately, we want to be in the spread business. Banks are good at taking credit risk, taking measured credit risk, and underwriting these credits. They're not good at betting on the direction of rates. So if that's your business model, you should be swapping these assets as they're originated. You could be doing swaps directly with customers through things called back-to-back programs, or you could be doing swaps on your own in the balance sheet in the background as these assets come onto the balance sheet. Because then we don't really care what the direction of the market is. We're just saying, look, we like this as a SOFR plus 200 credit, or we like this spread for this type of mortgage product that we're originating, and we're going to swap them as they come online, as they come onto the balance sheet. So the best hedging programs I see are using very vanilla instruments, things like pay fixed swaps to effectively shorten or eliminate the duration risk on those types of loans. But more importantly, they're doing it constantly. They're constantly adjusting their position as they add new assets to the balance sheet, not waiting a year or two to get burned and then say, well, like maybe we should swap 10, 15, 20% of the entire balance sheet to floating. I think that's, we're seeing a lot of that because institutions, broadly speaking, weren't prepared for this cycle. My hope is that as we go forward, people adopt more of these programmatic, kind of always-on hedging approaches.
That's interesting, and I like to try to end on a constructive note when I can on these podcasts, and in that vein and everything that you laid out today, Isaac. What do you think is the biggest point of friction to getting to that outcome that you've seen? Is it board members? Is it just executives just sitting down and spending time? Like, what do you think in your experience has slowed people down from getting to that endpoint and really kind of starting to think about their balance sheet and their earnings outlook more in kind of a NIM range versus being asset or liability sensitive?
Yeah, I think it's a good question. I think that I think that a lot of it is, I think folks still probably overestimate their ability to predict the direction of rates. I think that if you had asked me in the immediate aftermath of the banking crisis in March, that weekend, I would have told you that a year or two later that the industry at large would have gotten religion and we would never bet on rates again, and every institution would be hedging. That's a great scenario for a firm like ours because we're in the hedging business. So maybe that was wishful thinking, but we're still pretty far from that. I think definitely incrementally we see many more clients that have switched on these programs, and in general, the industry is absolutely moving in the right direction. To your point, I just think that and this is true for all corners of the market, not just community banks and regional banks, not just interest rate risk. Broadly speaking, in financial markets, there's always the allure to try to predict. The first thing that we always ask on these types of calls, the first question you always want to ask somebody is, what do you think the Fed's going to do? What do you think of the 10-year, right? It's a deep, emotional, desire we all have to try to predict the direction of the market. And in some ways, hedging is acknowledging that we can't predict, right? And I think that that's something that there's a lot of wood to chop left there. We're definitely moving in the right direction, but that's I think the biggest obstacle to setting up hedging programs is just the acknowledgement that we can't predict where rates are going.
Yeah. No, I think it's a great point, Isaac, and thank you very much for joining us. I think if I had to double down on something for our audience, it's, hedging, this is its purpose, right? It's because we don't know. And, I think in some ways there was a little comfort from the industry just because of ZERP and everything that happened. And, before the last year and a half, high rates was like 2%, like it's just on the Fed funds. It's just been a very weird environment. But this has been a great conversation. I appreciate it. I think you're going to be a busy man probably the next 12 months. And thank you for joining us.
Yeah, absolutely. Thanks for having me, Mike.